Hey everybody, Marty Mazur, good morning. It is the 4th of November 2019, Monday. I'm going to start today with the S&P 500 daily chart having a very nice rally this morning. Really good news on trade, at least for traders, at least for stock market traders. When I say good news on trade, I mean trade negotiations with China, trade rhetoric around Europe, and so on. Wilbur Ross, in particular, over the weekend, the Commerce Secretary, said maybe we won't need to tariff German automobiles. I know the president has said from the get-go that he really wants to, and they have the green light soon. But that was good news. No doubt the market's liking that today. Both from China and the US, they pretty much have promised that there's a phase one trade deal, kind of light on details, which probably means it's not a lot more than, I would guess, a decision not to hike tariffs on December 15th as previously scheduled, more purchases of U.S. ag products on the part of the Chinese. China really wants the U.S. to roll back some existing tariffs, may get a little bit of that to get more ag purchases in. By the way, folks, as I hear myself saying this, this has nothing to do with market forces. Just want to make that very clear, which makes me somewhat nervous about all this. But I digress. The elimination of all of the original 250 billion of tariffs is something that China demands to get a longer term deal. That's an area that the US says absolutely not. Another thing that was interesting this morning is Wilbur Ross seems quite celebratory in his statement that the US will be able to sell components to Huawei. And there's going to get a lot of pushback on that for national security reasons, but of course they will be, let's hope, components that don't pose national security risks to us. So make no mistake, and I think this is very clear, the administration is the definition of market-centric these days, and I think will be going forward for quite some time. So there's going to be a lot of what we really should call market manipulation. That's going to be commentary and tweets and suggestions that maybe in certain areas things are going better than they truly are. And traders, at least to now, continue to be willing to trade those headlines. I have shown you in the volume statistics. I showed you over the weekend in insider statistics, meaning the leaders of these companies who have the inside edge have been selling like they haven't since all the way back to 2006. So I have been suggesting that it makes sense to me, and in some of the indicators that I track, that, and I'm going to put air quotes around this, the smart money is using this opportunity as people barrel in to actually quietly fade out of this market. Makes a lot of sense to me when I look at the debt markets and the huge risk that I see under the surface that I've been illustrating for you here that has me very concerned. So again, nice breakout today. Zero in on this. You can see we've broken above this trend line. Still very marginal new high. Pushing up against 3,100 internally. I've kind of set that as an area that I think now is great resistance. Of course, as you know earlier, I thought we'd get more resistance up in here. Huge amount of short coverings. I showed you that short interest statistic that's been very reliable so far. It did bottom recently, so it does say that there's some unusual near-term risk for a sell-off here. Other things worth noting this morning is that gold is down. By the way, I mentioned that we're going to start scaling into gold. We still haven't. We're very close to it, continue to look at the trends and so forth. We're not going to go all in terms of our target allocation. We're just going to go in, slowly, 1 or 2% at first. I originally said 2%. I held off because, frankly, I felt that there's a nice stock market rally in the cards here, and that might depress the price of gold. It's interesting, you can see gold broke out of this this flag pattern. It's pretty bullish. And one of the things I was optimistic about in terms of gold going higher, but again, other information of the rhetoric around trade was telling me we probably have a nice pop in the stock market, and that could be, again, somewhat depressing to the price of gold. Today it's down a bit. So today we're selling off a little bit. It's down 1/4 point. Bonds are taking a pretty good hit this morning, by the way. So bonds and gold have been going in tandem. But if stocks are going to rally on the prospects for lower interest rates, that could be bullish for gold as well. So anyway, make a long story short, folks, you are going to see GLD, which is the gold ETF, show up relatively soon, probably in a small position initially in your portfolio. Another thing worth noting this morning is the VIX index, the volatility index, has shot higher by 6.2%. Now that flies directly in the face of this rally. That is options traders buying puts, paying more for implied volatility across the spectrum, puts, calls, etc., in the options pit on at the money S&P 500 options. So for whatever reason, I can tell you this, options traders right now are betting that this market is on the verge of a pretty noticeable dip. Now, I have seen the VIX go intraday from up 6% to negative, and that could very well be one of those days. But for whatever reason, options traders are very skeptical about this morning's rally. Okay, now I am going to just rip through my weekly analysis that I just completed. I want to start with this quote. People get all excited about the price movements, but they completely misunderstand that there is a bigger picture in which those price movements happen. Price movements only have meaning in the context of the fundamental landscape. To use a sailing analogy, the wind matters, but the tide matters too. If you don't know what the tide is and you plan everything based on the wind, you're going to end up crashing into the rocks. That is how I see fundamental and technicals. This is Cole Moshe, hedge fund manager. Folks, in our view, the tide is this. This is our PWA macro index. And as you can see, we were below the zero line. That says we have heightened recession risk out there. Now, historically, as we backtest it, now this is fair. This is a young index. I created this back in 2017, but I backtested it at key spots historically, not every week, but just at key spots. So look back here when we rolled over to a minus 10 in the late 90s. Market rallied to new all-time highs before it rolled over. Really rolled over big time here. Rallied to new all-time highs before it rolled over. Remember, I've been saying, look for a rally. And I keep saying to marginal new all-time highs. We rolled over to a minus 10. 5 or 6 weeks in the negative, 4 or 5 weeks in the positive, now several weeks in the negative again. I suspect that sort of thing probably happened back in here. If I ever have enough time, I'll test all those weeks. But why would that happen? Why would the economy start looking negative and this start looking positive? Well, we're seeing it. Politicians going hog wild trying to save the market for themselves because, they've got elections always looming. Fed governors, their job is to keep this economy humming, even though they know that we're going to have recessions, even though they know that they're probably just pushing asset bubbles up further and somehow praying that that's going to filter through to the real economy and make difference in the lives of everyday people. It's not how it tends to work out. Back in here, you tend to just inflate the asset bubble, and it just makes it worse the longer it goes. So, folks, I think it's the wind that's pushing this market higher, and I think the tide is pulling us closer to the rocks. So, folks, with our hedging, we absolutely have to continue to avoid the rocks. So we're not going to catch all of that wind right now, but I'm much more comfortable approaching it that way, and then just opening our sails and catching that wind when it looks like right here it actually may be blowing us in a not so healthy direction. So all the various colors in our index, financial markets are all over the place. Financial stress index is okay. You don't want to see any color in there, but that's the credit markets. And I think there's some distortions right here because there's so much issue and so subpar debt. There's a lot of cash willing to buy it right now because there's no yields anywhere else. So interesting setup there. The economic sub-index is in the red. It's all here in the general economy and in the business data. Consumer still holding up quite nicely. If this continues, the consumer ultimately rolls over because jobs numbers are going to begin waning if we keep getting all this red in here. But right now, and it could take us through the end of the year, things look pretty good on the short-term basis. The wind is definitely blowing upward, if you will. Okay, stocks to bond ratio. This is the S&P. This is the S&P relative to bonds. You can see when it looks like this, bad things tend to happen. S&P 500 versus small caps and transportation stocks. You can see right in here. Of course, these are very cyclical. They are underperforming the broader averages. Bad things tend to happen when that continues to happen. Not dramatic, but enough to paint a picture here. And then the monthly MACD and RSI. Momentum indicators versus the price. This is the monthly. You can see how it looked before the last two big 50 and 57% respectively declines. You can see how it looks now. Reason to be careful. Weekly, price, momentum indicators. Ooh, reason to be careful for sure. Daily, price, momentum indicators, reasons to be careful. Okay, weekly moving averages turning bullish again. So now that's bullish, although back in here when it's rolled over, we've stayed the course because our assessment of conditions, even though we weren't running a formal index, we still had a positive assessment of conditions. So this was all fine. This was fine in here. Not so fine now. This begins to roll over, and then you're going to have a fundamental sell signal, if you will, from when we look at things long-term as well as the technical. Right now, the technicals are improving with price. The monthly Bollinger Bands, wow, nothing to worry about there. Perfect, upward sloping 20-month moving average, price above there. Now, we'll see if we're about to rush into another big move higher, or it looked like kind of like that here before we rolled over. It looked like that here before we rolled over as well. So we'll keep our eye on that. And the 200-day moving average is beginning to slope positively again. Prices above the 200-day moving average. So these long, slower moving, slower to turn big boats are showing us some pretty decent signs. Down in here, the things that move before the boats move are not. So again, we haven't abandoned the market. We're just hedging right now. Dollar is beginning to roll over a bit. This is the year-to-date chart, if you can see that. My base case at the beginning of the year was the second half of the year we'd see a weaker dollar. I've been wrong up until recently. We'll see how that plays out. The monthly and then the weekly trend is beginning to roll over a bit. We'll see. That's actually positive for stocks, probably a weaker dollar would be. And then my down and dirty technical analysis, the moving averages look good. The divergences look a little bit suspect. What's looking better, frankly, folks, is the foreign stuff, pretty much across the board. In fact, look at the weekly rankings. The U.S. came in last place behind the Eurozone, Asia, our developed market index, and then the emerging markets. Same thing for the past month. Over the last year to date, the U.S. is still in first place, but waning of late. This is actually good on a net basis for our portfolios. We are hedging against the S&P 500. So if we have components in there like foreign and maybe like gold when we add it, if it works out that way, that'll actually give us a better result than what the hedge would have otherwise suggested to. And then lastly, sorry, this is going a little longer than I thought. Let me just run through just a handful of charts on my latest additions to my charts that drove me index. CEO and consumer confidence on different paths. Overall confidence in how they feel about their present situation. Again, the consumer, the CEO. Look how the CEO tends to lead the consumer, and notice what's happened in front of all the last recessions. CEOs, in terms of confidence, rolled over first, then the consumers, and then we had recessions and, of course, big bad bear markets. Same thing, across the board. There's the CEO, CEO now, consumer, and so forth. So not a rosy looking picture at all. This is the CEO confidence survey versus the S&P 500. You can see correlation there again. Not an encouraging sign. Free cash flow, the blue line. What companies have left over to do things with. Total dividends and buybacks. Well, they're doing more than their free cash flow. Again, in dividends and buybacks, like they did here. We had a rough patch here in the market, huge bear market, huge bear market. That's where we are today, folks. Spread versus spread of conditions versus expectations. Consumers feel real good about their lots right now, but not so good about the future. It's kind of in scary territory. One or two more. Long-term profit growth forecasts have tumbled for S&P 500 companies. And interesting one, I'll close on this one. Net worth to disposable income for Americans is 700% currently. Wow. 650% 2007, 615% in 2000, and Jerome Powell still doesn't think we have any excesses. Individuals' net worth relative to their disposable income. Why would that be of concern? Well, because this is what you call the wealth effect. If people are really out there spending because they feel richer, because net worth is growing in their homes and their stock portfolios. As folks identify with this, and as that begins to turn with the economy and with the inevitable fluctuation of markets, you could see folks really pull in, and that speaks to those surveys that I just shown you. When the consumer ultimately rolls over, bad things tend to happen. Now, folks, I'm not making a prediction. What I'm pointing to here in all the charts I just showed you and what's inside our own macro index and what the technicals are looking like. right now, the tide looks like it's pulling us toward the rocks. The wind, and there's a lot of people putting up big wind machines on the beach, the politicians, the federal banks, and they're trying to blow those boats back out to sea. Right now, the tide is still there. The wind is working. But how long can they continue to push the wind against the tide? One of two things has to happen. Either the tide's going to get stronger and everybody's going to crash into the rocks, or the tide is ultimately going to turn and the wind and the tide are going in the same direction. You clients out there, while the tide and the wind oppose one another like they do today, we're definitely going to have to hedge ourselves against that crashing into the rocks. And that's what we're doing right now with the options hedges. I'll leave it there. Thank you as always for watching and listening. Talk to you again soon. Bye-bye.